Howdy, Jacob here. Today we're looking at company 53 of our generic stock screener, Aramark, in the hotel, restaurant, and leisure industry. 8.6 billion market cap on 14.1 billion enterprise value. Founded in 1959, they have been around for a while. Looks like they provide food and facility services to education, healthcare, business, sports, leisure, corrections clients. They seems like they service a lot. Okay, so growth not crazy high, but somewhat consistent. It's still outside of this COVID year. You take away that craziness, and you're looking at a 3% CAGR, 2 to 4% CAGR a year over the last 10 years. Not terrible, but you're looking at high single digit gross margin, half that, a little bit less than half operating margin. The cost of goods sold is just consuming so much of the business. Dividend pretty consistent, and the earnings per share is quite a bit higher, so that's pretty positive. But pretty poor return on invested capital. So if I was this company, I'd definitely just be buying back shares, paying a dividend to give money back to my shareholders. Wouldn't be reinvesting. Let's see what they're doing here. A little bit of acquisitions, okay, fine. Issuing actually quite a bit of shares, and then the dividend of 107 million in aggregate is probably 30% of their 5-year average free cash flow. So nothing terribly concerning. But this balance sheet, let's see, 1.9 billion cash on hand, 1.6 billion short-term debt. So that is good that they have enough cash to write off that short-term debt. You're looking at 6.6 billion long-term debt. 6.6 billion long-term debt, and I'm seeing about 300 million in free cash flow over the last 5 years per year. 300 million a year over the last 5 years on average. That is 20 times their 5-year average free cash flow, meaning it would take 20 years if all of their free cash flow that they've averaged the last 5 years went towards debt reduction. Then they would finally be able to pay that off. I'm pretty concerned by that. That is a huge ratio. That is a huge amount of their free cash flow that would need to be going to debt to reduce it. And I mean, it doesn't really look like they're doing that. This would be one where it would have to be the screamiest deal alive. I'd have to really look into that debt, be comfortable if they're able to refinance it or not, because there's no way they're paying that off. They're going to have to refinance it. And that's usually due in 2 to 6 years. Long-term debt is usually due in 2 to 6 years. And so in 6 years, even if they were to flush 100% of their free cash flow at it, you're looking at 14 extra years. So it's not that situation I am 100% concerned about. But let's just make our assumptions here and then think about the debt situation when it comes to margin of safety. So I do think probably 3% seems reasonable. Due to their debt being so high, I'm using a P, price free cash flow, kind of closer to the enterprise value. Margins are really low, but they're consistent, maybe 2, 1.8. They have been increasing shares. 1% increase would be about 80 million. They're increasing about half of that, so half. Oh, and stock-based compensation. Yeah, let's increase that, 1.5 actually. So what I did there is just, you look at the market cap, what's 1% of that? 86 million. They pretty much do that in stock-based compensation, then again, half that in issuance, so 1.5%. Dividend is not huge, but I don't want them to increase it. They haven't increased it. I just want them to focus on debt reduction. And even still, I know I took it into consideration for their price to earnings, but it's just not. This is not a company I'd be jumping into. I would need to get it extraordinarily cheap, and I would need the debt situation to be either figured out by management to where they're telling me what they're going to do, and I see a start of action on what they're doing, or you have enough money, buy enough of the business where you've kind of forced them to do that. But yeah, definitely not a business I'd be jumping hands and feet. I don't know what that's jumping in feet first, whatever for. So hopefully you enjoy the video for yesterday. Thanks.